Did you know that the average person spends anywhere from $5 to $10 a day on Starbucks? That's anywhere from $1,800 to $3,600 a year just on Starbucks. What if I could show you how to redirect that money? Instead of blowing it on Starbucks, you use it to become your own bank. And that way you can keep more of your money. It's all about how much you keep, not about how much you make. If you can keep more money and have it grow and compound for you for the rest of your life, you can have a lot of money, become very wealthy by simply taking back what you're giving away. In this video today, I'm going to show you exactly how to do that. My name is Devin Burr. If you get value from this video, make sure to like it. I would appreciate that. And throw your comments in the comment section. I will make sure to get back to all of them. Let's jump into this. So you're probably thinking, wait, this guy is telling me to not have coffee. He's insane. I need my coffee. Without my coffee, I'm a maniac. No, I'm not saying not have coffee. I'm saying be smarter about it. There's these things right here called Keurigs. That's the one that I have. It was $90, $90, and I can have coffee every single day. Let me show you guys how you can redirect that money that you're spending on Starbucks. First, get yourself a Keurig. So now that you got your Keurig, you got your coffee, and you can enjoy your coffee on a daily basis, you're going to now redirect that money that you were spending on Starbucks towards a properly structured whole life insurance policy. So, what I've done is I've actually ran an illustration for you guys on a 20-year-old male. His name is Moneybags McGee. He's 20 years old and he is not going to spend any more money on Starbucks. He's going to redirect that money towards a policy built for infinite banking. What I did is I took $7.50 a day. So again, the average person spends $5 to $10 a day on Starbucks. I just went right in the middle, $7.50 a day for the entire year. So he's going to redirect that money. What it comes out to be is about $235 a month that this individual is no longer going to give to Starbucks. He's going to put it into a policy so he can do that. So he can become his own bank. So here's how it works. That comes out to, as you can see here, about $2,800 a year in total premium. That's what he's putting into his policy. These premiums are deposits. Becoming your own bank is doing just that, becoming your own bank. So you have to treat your money like banks do. Banks get deposits from everybody. Those deposits are their capital that they can lend out to other people and make a profit. So you got to view your premiums as deposits. This is money you're putting into your policy, and the capital that you can use is your cash value. So the cash value in this policy for good old Moneybags McGee, year one is $2,055. So he puts in about $2,800 into premium. That's what he used to give away to Starbucks. Now he's got capital that he can use, cash value of about $2,000. So the cash value he can use for whatever he wants, whenever he wants, and he won't interrupt the compound growth of the premium that he's putting into the policy. Now, not only does he have the liquidity, he can use the cash value, it's also protected against lawsuits and judgments. So nobody can take the money. It is a private contract between him and the insurance company. So it's a beautiful thing. So let's talk about how he can become his own bank. Now, this first year, he's put in $2,800. Okay. So his cash value, as I said, is about $2,000. What he can do is he can leverage that cash value to then become his own bank. A great way would be to, let's say, pay off a debt. He's paying a third-party creditor, let's say a credit card. He owes $2,000 on that credit card. He's going to use the policy's cash value to pay that debt off. And then he's just going to recapture the money. So whatever he was paying towards the debt, he's going to simply take that and pay it towards his policy. So now he's getting all the money back, the entire 2,000 bucks plus interest that he used to pay on that credit card. He's getting it into his policy where it's protected against lawsuits and judgments, where it's guaranteed to compound and grow tax free. So as he does that, he's going to have more and more money that he can actually start using to become his own bank. On the whiteboard, I'm going to show you exactly how that works. So that way you can practice it in your own life. So Moneybags McGee, he is being disciplined. He's not wasting his money on Starbucks. He's redirecting it towards becoming his own bank. So this money he was actually wasting on Starbucks is going into his infinite banking policy. The cash value, he's going to borrow it from the policy. So that's all the cash value is. It's an advance that the insurance company will give you of your future death benefit. They're using it as collateral, your cash value as collateral to give you an advance of the future death benefit. So your money is still sitting there compounding and growing 100% tax free without fail. So he's going to borrow against it. He's going to pay off the credit card. Okay. The credit card's balance was 2,000 bucks, let's say. He was paying 75 bucks a month for that credit card. I'm just throwing out arbitrary numbers here so you guys can get the concept. He's going to take what he used to pay towards that credit card of 75 bucks and pay it back to his policy. Because if he no longer has to pay the credit card, that is gone. Those payments are gone. He's paid them off. He's going to treat his money, his banking system, just like he was treating the actual bank, the credit cards. He's going to pay himself back. That payment of 75 bucks includes interest. So, over a 12-month period, if he continues to do this, he's going to be paying himself back $900. So, 900 bucks a year was going towards that credit card. He was losing that money forever. He's not changing anything besides who's getting the money. Instead of the credit card getting it, he's getting it back. So he's got 900 bucks that now goes back into his policy where he has full control of it. As soon as he puts the payment back into his policy, the $75 payment, he can use that again if he needs to. So all he's going to do is he's going to keep paying himself back because he doesn't lose control of the money. So 900 bucks that year goes back into his policy. Now check this out, guys. Year 2, I'm looking at the illustration here behind me or behind the screen. Year 2, his cash value goes up by $2,400. So he puts in another $2,800. Again, that's money he used to spend on Starbucks. And his cash value grows by $2,400. So it's more than it did the first year. It's because of the compound interest. All of the money he's putting into his policy is continuing to grow and compound tax-free. So he's paid himself back $900 plus his cash value has gone up by $2,400. So that is, what is that, $3,300 that he now has in cash value inside of his policy in year 2. So now what he can do is take this $3,300 and pay off another debt. Let's say he's got another credit card that's got a $3,000 balance. Okay. He's going to pay that card off by borrowing those funds. The cash value is money he can use at any time with no credit checks, no financial statements, no questions asked. If he's got cash value, he can use it for whatever he wants. I mean, for crying out loud, his name is Moneybags McGee, right? So he takes the 3,000 bucks, pays off another credit card. Let's say the payment on that is 100 bucks a month. So now he's got 100 bucks a month that he's recapturing from the second credit card, and he still has the 7,500 that he's recapturing from the first credit card. So that would be 1,200 plus the 900. So he's actually recapturing into his policy in year 2. What would that be? $2,100. So 2,100 bucks of money he used to lose to the credit cards. He's getting it back now. That's the power of becoming your own bank. All of these payments that he's making, he never loses control of them. If he needs to use that money, he can use it anytime for whatever he wants. But he's going to let it build back up $2,100 over that next year that he's going to be building back up into the policy. Now, year three, looks like the cash value goes up by a little over $2,500 this year. So he puts in 2,800. Again, that was money that he used to spend on Starbucks, but he's got his Keurig now, so he's golden. He don't need Starbucks no more. Oh, coffee's good. So $2,500 growth for putting in 2,800. This is going into year three. So now he has $4,600 of cash value that he can start using. This is just 3 years in. He's only 23 years old at this point. You guys see how this starts to snowball. Once he doesn't have any debts any longer, he pays off all of his debts. All the money he used to pay towards debts is money that now he can keep. So guess what he can do? He can get more money into his banking system, more money to compound and grow. And by the time he's even just my age, I'm 40 years old, he'll have a stupid amount of money, not including all of the recapturing and all that stuff that we're talking about here. If we just look at the policy itself, and I'll pull this back up on the screen so you guys can see it actually. This is the concept. This is the strategy of infinite banking. The policy is just the vehicle, but I'm going to show you just the vehicle, how well it performs later on in life. This is the concept. The concept will make the vehicle way better, but I'm just going to show you guys the vehicle so you can see just how good it is, taking the concept away. The concept is what makes it really, really powerful. Guess who's back? Back again. Moneybags is back. Tell a friend. So Moneybags McGee got his policy back up for you guys. Let me show you what I was talking about earlier. So we have a cash value growth the second year, as I was telling you guys, $2,400. And the third year, $2,500. The fourth year, 27. The fifth year, almost 29. The sixth year, 3,000. So it just keeps getting better and better, guaranteed. This is, again, not taking into account the entire concept of what I was showing you guys, how he was recapturing the $75 credit card payment and the $100 credit card payment. This is just the product, the policy. Here's how it performs. 2,800 goes in, he's got access to $2,000 of it. The next year, 2,800 goes in, it goes up by 2,400. So he's only giving up control of a little bit of money 2 years in. Year three, 2,800 goes in, he's got access to about 2,500. So again, giving up a little more control. Year four, $2,700 growth. Year five, 2,800 goes in, his growth is almost 2,900. So by year five, this guy is only 25 years old at this point. His policy is now efficient, meaning when he puts money in, he has access to all of it and some. And the further along we go, the better it gets. So look at this. When he's 30 years old, so when old Moneybags McGee is 30, he puts in $2,800 and his cash value grows by $3,800. So puts in 28, grows by 38. So that is a good return just 10 years into the policy. Again, I can't stress this enough, guys. This is just the product, how you use the product. What I talked about prior, the strategy of infinite banking is really what makes the product special. And the control you have, the protection against lawsuits and judgments. I haven't even mentioned the death benefit. We're all guaranteed to die. So when that happens, old Moneybags McGee is going to give a ton of money tax-free to his family. So I'm going to show you that a little more later on too. Let's look at when he's about my age. So when he's 40 years old, at this point, The most he can put into his policy is $903 per year. The reason for that is the first 10 years, what he was doing, he was overfunding a regular off the shelf whole life policy. He was putting more money in to get cash value. You can only do that so much. If you do it too much, the policy becomes taxable. So at year 10, he can no longer do that. He can only put in 903, which is the regular whole life policy. So by that time, 903 goes in at year 20 of his policy. So when he's my age, 40 years old, he puts in 903. The cash value grows by 3,300, almost 3,400 bucks. So think about that, guys. Puts in 900 and it grows by 3,300. That's insane. That's just, again, the product, how efficient it gets. And it's because the compound interest never stops. So let's look when he's old and gray. Let's say when he's 80 years old. So at 80 years old, he can no longer put premiums into this policy. So the policy is fully paid up at age 75. So at 75 years old, the policy's paid up. He can no longer put any money in it. If he does, it becomes taxable. So when he's 80 years old, no premiums go in, and the cash value grows by 19,000 bucks. Again, he put in nothing and it grows by 19 grand. The next year puts in nothing and it grows by almost 20 grand, 19,900. So that's the power of the product, but using the product is what makes it special. And that's why the strategy, the concept of infinite banking, it's a strategy, it's a concept, it's not a product. This is just the best product to use because of all of the money is protected against lawsuits and judgments. You have total control. You can borrow the cash value anytime you want for whatever you want, no questions asked. And your family gets a death benefit that grows over time. So let's say when he passes away at 80, if that's when he passed away, the death benefit grew all the way to, $531,000. When the policy started, you guys can see the death benefit was only $81,000. So that's the beauty of these policies. They're built for the cash value. So the death benefit early on is lower, the cash value is the highlight. So the death benefit gets lowered, which lowers commissions to the agent, and the cash value is what's highlighted in the policy. So most of the premium is going to cash value instead of most of the premium buying a death benefit. If most of the premium buys a death benefit, the agent makes a ton of commission. So these policies are designed to have low commissions, high cash value, protection against lawsuits and judgments, non-taxable growth that's 100% guaranteed, it'll never stop, and a death benefit that always grows. So the longer he lives, the more he can use his policy, the bigger the cash value gets, and the more money his family will have when he inevitably passes away. So, guys, this is how you can use your money that you're throwing away on Starbucks to become your own bank. All right, guys, so Moneybags McGee, that is an example of how you can practice infinite banking on a small sum of money and basically just take things out of your life that are unnecessary. I call it lifestyle bloat, where you're spending money on a lifestyle thing that you don't really need. You don't need to go to Starbucks every day. You can simply get a Keurig, have your own coffee at home, save a bunch of money, and direct it towards becoming your own bank. I will tell you this, the more you put into a policy, the better. So if Moneybags McGee had just a lump sum of money sitting in the bank, 10,000, 15, 20, whatever, if he took that money and did a dump into his policy, he's going to get instant cash value that is super high. It would actually be about 90% of what he's putting in. So if he puts in 20 grand, he's got access to like 18 grand right away. And then he can really start becoming his own bank and practicing the concept on a bigger level. If you put in 100 grand, he's got a ton of money at that point that he can really start using for the concept. And that's more money compounding inside the policy from day one. Compound interest takes time. The longer you give it, the bigger it gets. So if you front load a policy, if you put more money into it early, the numbers just get ridiculous. The cash value growth gets ridiculous. The death benefit gets ridiculous because it's just more money compounding for longer. So guys, I hope you got a ton of value from this video. If you're ready to take back control of your money and you want to become your own bank in your own life, check out the description of this video. I've got a training video. You can watch that, but at the end, you can schedule a call so we can help you become your own bank. If you got value from this video, make sure to smash that like button. The algorithm loves it. And I would love you guys for doing that because it helps me grow the channel. Everyone wins. If you liked this video, you're going to love that one. Subscribe to my channel if you haven't already. Until the next video, I love you guys. Peace.